As we look ahead to the budget, one thing is clear. The financial pressure on individuals, especially those in the urban areas, is only growing. With everyday expenses reaching new heights, it is crucial that the budget brings about the relief that most of us desperately need. Let's explore the changes that are long overdue. Adjust the 30% tax slab to Rs 18 lakh. Over the past few years, the cost of living has climbed steadily. Inflation has surged, impacting everything from daily groceries to rent and healthcare expenses. Now think about this in the context of our tax system. While most tax slabs in the new regime have been adjusted to account for inflation, one hasn't: the 30% tax slab. It is still fixed at Rs 15 lakh, despite the cost of living rising significantly since 2020. Since 2020, the cost inflation index has risen by 20.59%. The 5% and 10% tax slabs have seen meaningful adjustments taking into account inflation, 40% and 33% respectively. But the 30% tax slab has remained unchanged. Adjusting the 30% tax slab to Rs 18 lakh is a 20% increase. This simple adjustment would ease the tax burden on higher income earners who are seeing rising costs in urban areas. This will also ensure that our tax structure stays responsive to economic conditions. For example, by increasing this threshold, taxpayers would retain more disposable income, enabling them to invest, save and spend in ways that boost the economy. Fix the tax brackets for fairness. Let's take a moment to think about what goes into managing a household in today's cities. Rent is climbing, home loan EMIs demand a chunk of income, healthcare costs for aging parents keep rising, and school fees are no small expense. Now imagine a family earning Rs 15 lakh annually. While this may seem like a comfortable income on paper, it actually leaves little to no room for savings or investment. Your tax-free income currently stands at Rs 7.75 lakh. Rising this limit to Rs 10 lakh as proposed is a positive move that benefits many. But we should also consider how this impacts other taxpayers, those whose income exceed Rs 15 lakh and contribute significantly to the country's tax revenue. In the assessment year 2023 to 2024, nearly 2/3 of all the taxpayers did not pay any income tax. Meanwhile, just 10% of the taxpayers, those who earn more than 15 lakh, shouldered 94% of the income tax bill. Tax rebates are only available for those earning below Rs 7 lakh. For those earning above the threshold, their tax obligations are calculated in full without relief. While supporting lower income groups is crucial, higher income earners, especially those in urban areas, are managing rising living costs with limited scope for tax relief. So what can be done? Enhancing the tax bracket for equity could be a solution. For instance, incomes over Rs 15 lakh have been taxed at the same rate since 2020, even though inflation has significantly increased. By reassessing the tax brackets and offering proportional relief, we ensure that the tax policies are evolving with the times. This approach not only acknowledges the contribution of higher earners but also supports them in managing modern living expenses. 30% deduction on savings and insurance. Over the past 5 years, we have seen some major shifts on how the tax regime works. While it simplifies a lot of things, one area that stands out is the lack of deductions. Fewer Indians are opting for life insurance policies, leaving families vulnerable in the face of unforeseen circumstances. Contributions to the National Pension Scheme, a vital tool for long-term financial planning, have stagnated. Tax-saving instruments like equity-linked savings schemes, which encourage both investment and tax efficiency, are also losing traction. These trends paint a worrying picture as they indicate a shift away from structured financial planning and toward a short-term consumption-driven mindset. Without the incentive of tax deductions to nudge households towards disciplined savings and investments, the long-term financial stability of Indian families could be at risk. So why does this matter? Because as inflation rises and incomes stagnate, families are feeling the pressure. They are borrowing more, and unfortunately, this is leading to higher loan defaults. The idea behind removing deductions was to make things simpler, and in many ways it has. The government's goal is clear: to grow revenue to fund India's infrastructure. However, as we have seen, the lack of tax incentives for savings and insurance is leading to concerning trends. It is important that we expand the list of deductions carefully and strategically. To keep things simple and effective, a flat 30% on gross income capped at Rs 15 lakh would go a long way to help Indian families plan better. Let's say your gross income is Rs 10 lakh. With a flat 30% deduction, you could reduce Rs 3 lakh from your taxable income, whether that's for investments, insurance, or essential spends. This is a solution that aligns with the government's need for growth while addressing the immediate financial needs of taxpayers. The clock is ticking and the government has a real opportunity to make a difference with the 2025 budget. If you found this video helpful, then don't forget to like, share and subscribe to our channel.